The area of the age pension can be difficult to understand, and there are very limited ways in which you can increase your entitlements. Today we're going to discuss the age pension eligibility. To qualify for the age pension, you must have reached age pension age, which is gradually increasing to age 67, be in Australia at the time of applying, and been an Australian resident for at least 10 years or more, with at least 5 years continuous residence. And you also need to meet the means testing requirements. So let's talk further about means testing. There is both an income and an assets test. Both of these tests are used, and the test that calculates the lower level of payment is the one that's applied. The income and assets test contain a lower threshold and also a cut-off level. If your income or assets are less than the lower threshold, your entitlement is not reduced under that test. Importantly, the lower asset threshold is different for homeowners than it is for non-homeowners. When your income or assets exceed the lower threshold, your entitlement starts to decrease. Then, if your income or your assets reach or exceed the cut-off level, your entitlement is nil. Again, the assets threshold is different for homeowners than it is for non-homeowners. Under the assets test, you and your partner's assets are added together. Your partner's assets are included regardless of whether they themselves are claiming a payment. Assessable assets include financial investments like cash, term deposits, loans and shares, superannuation where the individual is over age pension age, real estate outside of your own home including vacant land and holiday homes, farms and businesses including goodwill, home contents, motor vehicles, boats, caravans, antiques, paintings and collectibles. Even gifts over certain thresholds are assessable too. The main assets that are exempt are your own home, including the surrounding 5 acres, prepaid funerals or funeral bonds, and accommodation bonds to aged care facilities. Centrelink assess assets at the net market value. The net market value is the amount a person would expect to receive if they sold the asset on the open market, less any debts or amounts owed. Under the income test, you and your partner's income are both included. As with the assets test, your partner's income is included regardless of whether they are also claiming an age pension. The way that Centrelink assesses income can be very different to the actual income paid into your bank account. Assessable income includes deemed amounts from financial investments, salary, wages, business income, net income from investment properties, income from boarders or lodgers, and some family trust distributions or dividends from private companies. Some of the types of income that are excluded include a lump sum withdrawal from superannuation, capital gains, payments from family members, and some insurance payments. I mentioned that deemed income is used for financial assets. Let's touch on that a little more. Centrelink assumes all financial investments earn a certain rate of income regardless of their actual earnings. Therefore, if your financial investments earn more than the deemed rate, that extra income is not assessed. To calculate deemed income, the current percentage deeming rates are applied to the market value of the financial asset. Some of the financial assets subject to deeming include bank accounts, term deposits, loans, shares, managed funds, or gifts when they're over certain thresholds. Superannuation when you're over age pension, and account-based pensions. We've briefly covered both the income and the assets test, so remember that both of these tests are used, and then the test that calculates the lower level of payment is the one that's applied. There are lots of additional rules and exemptions outside of the income and the assets test too. Therefore, it's best to seek professional advice to understand how the rules apply to your changing circumstances.